Hi, welcome to mediatorpodcast.com, a podcast and video series about all things related to mediation, negotiation, and settlement offers. My name is Melissa Gragg, and I'm a financial mediator and corporate valuation expert in St. Louis, Missouri. I've authored several books, including Anchor the Deal, a book about divorce mediation and negotiation settlement offers. But my guest today is a renowned expert in her field. Please welcome Laura Phillips to the podcast. She's a reverse home mortgage specialist in Colorado. She services clients in Florida, California, and Arizona as well. She has over 25 years in real estate lending and brings an option for mediators that you may not know about and therefore have not been utilizing it when you're dealing with couples. And so this is one way that mediators could utilize this option when dealing with couples in gray divorces, or if you're a financial advisor who is dealing with preserving retirement assets. So there's a lot involved here. Welcome, Laura. How are you today?
Thanks. And thanks for having me on board.
Oh, this is going to be a great conversation. So we're talking about reverse mortgages today. And basically, let's just start it off with how are they different than a traditional mortgage? Because I think I've been in the financial world for quite a long time, and I thought I knew what a reverse mortgage was, but after talking to you, I don't think I really had a basis. So maybe you could start us off with like the differences, and so we can get a primer on it.
Absolutely. Well, let's start out with it's a mortgage. A lot of people don't understand that, but it is literally a mortgage against your home. It's no different than any other mortgage you've had on your house. So that means that you own your home, you stay in title. So that's always a big concern when people think about reverse mortgages. But other than that, it is a mechanism to allow people who are 62 years and older to be able to tap into their equity of their home and not have to make a mortgage payment. So it's really allowing seniors who may be on fixed incomes or people who are separating and now looking at living on a single income versus living on a double income, a way of using some of that equity to help them continue to live the rest of their life.
Well, and I think that it still is not super clear to me, because I think in a lot of situations, it's just really has gotten a bad reputation. Like for the most part, I think when I hear reverse mortgages or even say something about it, people are just like, oh, you wouldn't want to do that. So like, why do we have that perception that this is not a great situation?
Well, reverse mortgages have been out since President Reagan's era. So they've been out for quite a long time. And they were originally designed to help a woman whose husband had died, who had 5 children, for her to be able to stay in the home while she finished raising her children. So there wasn't a lot of thought involved with it. How to make the guidelines be safe for a senior. So one of the original ones was that they would only put the male on the loan. And so when that person passed away, the wife, the female, the spouse, was literally left on the street. And so you literally had widows on the street because a reverse mortgage was done. They sold the home, and where did she go? So, that was kind of an afterthought that they were like, oh, we probably need to really think about that. The other big thing that I think they didn't think about in the beginning of these loans was, can the people who are living in their homes still be able to make their taxes and insurance payments every year? So if you don't make your tax payment, it becomes a tax lien and can cut in front of a mortgage. Mortgage companies don't like that, and actually be sold out from underneath a mortgage. So that's another way that people lost their homes. So when people talk about your grandmother's reverse, those are the ones they're thinking about, that maybe they did lose their home because of a foreclosure, but it was probably because the taxes weren't covered. Nobody checked to make sure that they even had enough funds to do that. Or in the very, very early days, that they didn't put both spouses on. So I tell people it's not your grandmother's reverse. It is a kinder, gentler reverse mortgage with a lot of bells and whistles and checks in place to make sure that it's regulated well to protect the interest of the senior.
Well, and I think that when we were talking about this, because of course we talked a little bit about this before we start to shoot, and it seems like it's a really hot topic in like gray divorces and things like that. And when I originally was talking to you, I was trying to figure out like why it would be used or how it would be used and like the typical person, because I was wondering, like, is it always going to be people that are in advanced age or retirement age, or is it potentially for somebody who comes in with a house? Like, what if they receive a house that's fully paid outright, like in a divorce, but they're sort of house rich and cash poor? So maybe we can start off with like who's the ideal candidate for a reverse mortgage and maybe who isn't in your mind.
Let's do the who's not, because
Okay.
I really believe that it's probably something that all of us as seniors should look at as an option in our lives. But there are some real candidates that it's not great for. So if you were to leave your house to your children, a reverse mortgage may not be the best loan to look at. And the reason for that is it's going to carry a balance that the children are going to have to pay off. So if that's something that's really important to you, then or heirs, in the sense of that they're going to live in that home, then this may not be the best loan to look at. I think it should be considered as the mix, but I would probably say, if you were talking to me, that I would say this is probably not the best fit. Let's look at something else that might be a better fit. The other one that comes into my mind as not a great fit immediately is somebody who wants to move in the next 5 years or so, plus or minus. That 5 years is not a hard number, but they're going to move in the near future to future. And they want to move to be closer to family or whatever, or maybe change a lifestyle and move from, I live in the Rocky Mountains, move from the Rocky Mountains with the snow every year down to the south where you don't have to deal with the snow, and it's summer most of the time. So, I mean, those kinds of moves, it can be an expensive loan to do. And so in most cases, it's a one-time loan, and we would want to make sure that we're looking at, is this loan going to fit your needs now and going forward? And if you're going to tell me, no, I'm going to move to see my kids and live closer to them because they're having grandbabies and I want to be close to them, or I'm going to move because I want to be in the South and not have the winter weather, then I'd say, let's talk about when that might happen, because a reverse mortgage can be used as a purchase, and maybe that's a better fit than doing the reverse mortgage on your primary home right now. So as for who's a good fit, I would say I actually have a sheet, and maybe we can put that out for your clients to look at. And it says, are you a good candidate for a reverse mortgage? And there are about 15 questions or so. And if you answered yes to a couple of them, it's definitely worth a consideration.
No, I think that is, I think, again, still understanding, what a traditional mortgage is. I think that maybe we could either talk about a real life example where this reverse mortgage came into play, but in my mind, I'm trying to wrestle with like what actually is the reverse mortgage. And maybe I'm like being kind of dense about this, but like, are you like if my house is outright, if I own my house outright and it's worth 200,000, are you saying that I would get a mortgage on my house and you would give me the $2,000? Or like, how does that work, like structurally wise?
Absolutely. And we can cover that.
Okay.
So let's use your example of the $200,000 house is free and clear, and you're 62 years or older.
Okay.
So there is a formula. Unfortunately, it is, remember your old logarithm kind of tables that you had in high school? You had to flip to the back and look over and down a column. It's kind of the same thing. So if you're younger, you will have less ability to tap the equity in your home. As you get older, one of the benefits of getting older is that you will be able to tap more equity. So when you're 62 years old, you might only be able to tap tap about 40% of your equity. So if I do math in my head at $200,000, 40%, you would get
80,000.
Thank you. So you can do math faster than that. I have to get the calculator out. $80,000. But that's $80,000 that's in your ability to use at any point. You can use it as a line of credit. You can take it as a 10-year payment. You can mix that up, 10-year payment 1 year, line of credit later. So, and we don't care what you do with that money. It's your money. It's like proceeds from a loan. It is not taxable, but I'm going to tell everybody on this call, I'm not a tax expert. Definitely confirm that with your personal tax experts about that. But my understanding is that tax loan proceeds are not taxed, so you will have it to be able to use. So a traditional mortgage, you make a payment every month. So you get, hi, welcome to ABC Mortgage Company, and here's your payment. You pay $1,000 each month. On a reverse mortgage, you don't make a payment. You don't have to make a payment. It's the only loan I know out there in the world that does not require you to make a mortgage payment. Now, if you get a reverse and you want to make a payment to keep that line of credit balance active and high, then you can do that. If you win the lottery, you can make a payment, but you don't have to do it. And that's probably the biggest difference.
Okay, and then realistically, let's say, you do pass and your children, then the house comes into their estate. Right. They would then, so this is why at the beginning you said if you want it to leave the house to your children, then that might not be a good offer. But if they had intended to sell it, then they would sell the property, pay, get the 200,000, pay off the $80,000 of debt. Correct. Right. And then they would still have money basically from the sale of that property.
Absolutely. And that's exactly how that works. And if they did want to buy it, there is some provisions in the servicing of the reverse mortgage that would let them to buy it at 95% of the value of the loan. So, there's even an opportunity to allow them to buy it, even with that. And my best example was a woman here in Colorado that took a reverse out, but didn't use much of it. She had a line of credit, but she just didn't want to make the mortgage payment any longer. And she wanted to have a small line of credit for emergencies. Well, when she passed, the family was trying to decide whether they wanted to buy the home for a sibling to live in or not. Well, the house was probably worth $600,000 or $700,000, thanks to wonderful appreciation we've been seeing happening across the country. But the loan was only $200,000. So this was a rare example where the family she could have had the loan, she could have passed and still been there and had the capacity to go out and get their own financing to buy the house and do that at 95%.
Okay. So I think that clears it up a lot more for me conceptually, because I was kind of thinking that you would be taking out the whole, like a traditional mortgage, like you would take out this whole amount, and then basically at the end of the day that somebody would own your house and like you wouldn't really own it anymore. Like that's what I kept on thinking in my head. Is that a normal like misconception?
No, it's a very normal misconception.
Okay.
That the bank's going to own your home. I hear that a lot. The only person who can get the most amount of money out of their home is somebody who's in their 90s. I did have a gentleman who was in his 90s take out a reverse mortgage, had his own specific reasons on why he wanted to do that. The house was free and clear, and he was able to tap 67-ish%, not quite 70% of the value of the home. So you can see there's a big difference between 62 at 40% and 90 at, let's just say 70%, just for numbers' sake. And in between is where the rest of us all fall. So the idea is not to have the house be worth less than the loan. I mean, banks, they are lending institutions. They're not in the business of owning real estate. They're in the business of lending money and earning money on interest. So they really don't want your house. That's not That's not their purpose behind it in any. And so the new guidelines and rules which came in when President Trump was president the first time around, he lowered the amount that was allowed to be tapped in equity to keep that from happening. Because again, we don't want to see another situation like we did in 2009 through 11, where we had the breakdown of equity in homes. Nobody wants that.
Well, and this still kind of leads us into, I know we kind of gave the example of what I was talking about, but did you have another example that you wanted to kind of talk about of how this helps somebody in a situation or a gray divorce? Because again, I could see somebody receiving a house in a divorce and but not having like all the equity is in the house and there isn't any other assets. Maybe there's not a retirement or anything else. And so if anything, maybe there's an example of how this has helped with, that long-term financial planning or an incident that happens, or even maybe in an emergency, you would need something like that. Where do you see that this is best used?
I see the line of credit as being the most popular of the loans of the reverse. It does have a fixed rate. So it's just like all the other loans you've looked at there. It's fixed rate and it's an adjustable rate. The adjustable rate offers you the line of credit. It seems to be the most popular loan nationwide with reverse loans. So what does that mean? So it means that we have this bundle of money in a line of credit, just like you've had when you've had seconds on your home. The difference is it grows each year. So if you don't use that line of credit, then next year you have access to more dollars. Now, we'll never see that with a bank in a traditional second. So you asked me how I've seen that work in a divorce scenario. The person I'm thinking of in my mind, she was a housewife pretty much the whole time, and there was nothing wrong with that. It was what she chose to do, and she did work some, but most of her time was taking care of the children. When the children were older, then she went back to work, and then her parents and his parents aged out. She went back to being a caretaker for them. So she really didn't have a huge savings. She didn't have a huge 401k when she left her job, and over a period of time, they felt they just didn't want to be with each other any longer. It wasn't going to work. He went on and had his company and he wanted to keep it. And she really loved the home. Had all the memories of her life there. So she wanted to keep the home. So she ended up at the house being free and clear, but then thought, how am I going to be able to afford living in this home? How am I going to be able to afford the taxes? I make, a minimal amount of money on Social Security and my 401k payouts. The reverse mortgage allowed her to have a annuity, which is like a Social Security payment coming to her each month to just help make ends meet. And then it also allowed her to have that line of credit. So when the hot water heater went out, she didn't panic. She didn't have to sell what little stocks and assets she had, and was able to cover those emergencies that way. So even though she had worked her whole life and had provided a great life for her and her family and for her husband at that point too, she was able to take the home free and clear and be able to create a new life for herself in the next 30 or 40 years of life afterwards. So you bet. There's a lot of good ways you can use it.
Well, and I think even in some situations, if you have family members that you have to take care of, or, in some situations, what if you're an only child and both of your parents need some assistance? Like there could be even a way that they could stay in their home and, get some of that money out to pay for expenses or to have some sort of care within the home. Like there actually could be a lot of ways that this could be utilized in some capacity.
That's actually an excellent one, as you pointed out, was taking care of staying in the home. A gentleman had run through all of his savings and was 95 years old. But hey, he wanted to die in his home. He wasn't going to go to any living places, that he was there. And they were trying to figure out how to pay for all those live-in care people to come in. And they used the house as a reverse mortgage to cover the funds. And it covered it quite comfortably, so that the son, he was in Santa Fe, house was here in Colorado. He didn't have to worry about how was dad going to be cared for. He let the caretakers that had been in the house were comfortable. He knew them. Dad was very comfortable to the very end in the home. And the funds were there to be able to cover every bit of the cost. And that included some modifications to the house. So obviously he, at that point, was on oxygen and in a wheelchair. So they had to make a few adjustments to the kitchen for that and into the bathroom for him on that. And that reverse mortgage covered those adjustments quite nicely.
Well, and another thing that we had talked about was that this could be utilized for business owners or real estate investors in the reverse mortgages. So I have no idea what that would look like. So where do you see that come into play? Or maybe you can give us some scenarios.
Well, the immediate one I can think of is for real estate investors. I'll think about a business scenario, but I've had the real estate investor scenarios happen. It has to be on your primary home. So we can't do it on second homes or on rental homes. So your primary home has to be not free and clear, but you have to have equity in it. You have to have at least 50% equity. That's a good number to work with to make a reverse work. If you have that or more, then you can take that funds out. Now, once those funds are in your hands, you can go out and buy real estate, or you can join real estate REITs. I think now that's getting a little over my head, I understand, but you can join co-ops to be able to buy real estate, and you can do that anywhere in the U.S. with your funds. So that's definitely a way to use a reverse to help build a real estate portfolio without a lot of trouble.
Oh, I like that. That's interesting because, I mean, realistically, you could have a primary house and then go and buy like a lake house or something with taking some of that mortgage out now. And when, if your estate ever transfers, yes, they would have that mortgage that they would have to deal with, but they could potentially then sell one of the properties afterwards. And you would basically be able to have like two. That's an interesting concept. I like that.
You could buy a strip mall. You could buy commercial property. You could do that.
Yeah.
You could buy the lake house. You could be a young senior, buy a lake house and build family memories in that lake house, and then continue to use that and let the heirs decide if they want to keep it, sell it, or use it to build more real estate properties in a portfolio. Now, for the business owner, I haven't had any business owners talk to me about using it, but I'm thinking if you had equity in your home and you have a business and you'd like to expand, you would like to put some money into the business. Business is successful. It's not drowning, but you see a possibility to expand that niche that you're in, then that reverse mortgage could help you do that very, very easily. Again, we don't ask you what you do with your money. It is your money. If you want to take a trip to the moon, and whatever that costs these days, and you have the funds to do that, you could. It's just your funds.
Well, and if you because a lot of times business owners are a little bit of also real estate investors.
Right.
And I'm just wondering, like, if you had the primary house, you go and buy some sort of rental property, you Airbnb the rental property, which makes money, which then pays off the reverse mortgage, and you just do that over and over again.
Right.
Like, this could really be a tool to utilize. Now, is some of the same process to like get a loan, involved? Because do you have to prove like income or things like that? Like, how do you get qualified for something like that?
So it's an asset-based loan. Two things. You have to be a primary home and you have to be at least 62. Now, we do have a jumbo product, which will allow you to be 50 and older to get to use it. And that jumbo product does go to $4 million. So for those homes that now have had great appreciation, we have loans out there that can do that. But let's just talk about the standard vanilla one of the 62-year-old home. Those two things have to be in play. You have to have it as a primary. You have to be the right age. The third thing is you have to be able to afford your taxes and insurance. Okay. If not, then we have an escrow line that comes in and we'll do it. So in the future, with your reverse mortgage, you, the individual, are going to be responsible for your taxes and insurance. And it's no longer part of the escrow payments that you've been making. Big change mindset wise. And that's going to be one of the things that's going to be talked about a lot when you do the counseling. Now, you do have to take a counseling class. That is by a third person to make sure that you understand what you're doing. It is different. It's not scary. It's not a bad loan. It's been out for a long time, but it is different. These are some of the rules and guidelines, and you need to understand what they are going forward. Other than that, we look really at the asset of the home. So it's the appraisal and what's against it lien-wise. We make sure that you have enough income coming in to cover your taxes and insurance and your HOA. If you want to know how to do that in your own head, it was to take a yearly premiums for all three of those items, divided by 12, and that's the amount of income that needs to show coming into the house to be able to qualify for the loan. Have you had a bankruptcy? It will affect the situation from the fact that they will probably do the escrow account, which means they're going to take those funds and put it into a separate escrow account to make sure that they're paid so you're not worrying about it. But we're not really looking at FICO scores. We do pull a credit report, but it's not as FICO score driven as normal loans, and certainly not as driven for income and me asking for 1,001 pieces of paper. So,
Yeah.
yeah.
Well, and again, like on my mind, it's one of those things that I guess sometimes you have a perception about something and you don't see all of like the theory because, again, I think that I've seen this topic of reverse mortgages and gray divorce and things like that. And I want to talk more about its importance, but I could easily see how this could be used in gray divorce. So tell us how you've seen it be utilized when somebody is divorcing after 62.
One of my favorite ones was after 62 and divorcing. She actually had a better 401k than him. And she wanted to make sure that 401k was 100% hers. She worked really hard at that. So she took the house and she put the reverse mortgage, or she got the house in the settlement, took the reverse mortgage on the settlement, and paid to keep her 401k entitled to her. So in that particular case, she didn't have needs and it could be a he, to be honest with you. It doesn't have to be a she or he, but it's just that it's the surviving party for the house. Let's put it that way. That they could use those funds to protect themselves, to keep their 401ks intact or their retirement funds intact, or to actually just stay in the home and live. It was a home that they really wanted to be in and live in it.
Yeah, I mean, I think we face this in mediation all the time with divorces when we're dealing with the financial picture, is that, you have this house outright and you have these other assets. And obviously, if you take money out, like during the divorce, you're going to be able to split your retirement assets and not have a penalty or any taxes.
Mm-hmm.
But it's usually very hard for somebody to pay out, the equity in the house. So I could see easily that somebody could say, you know what, we want to keep our own 401ks. I'm going to pay you out. I'm going to get this 40% out of the house. Somehow they figure out how it evens up, but I'll take this 40%. That person gets the cash. There's no tax consequences for it. Right. And you sit back there on a loan, whether you pay it off in the future or not. When you go to sell the house or your estate sells the house, you would still be getting your equity or even the growth in the equity. And it seems like an ideal way to, we do see a lot more divorces. People think that there's a lot of money in divorces, but a lot of times they just may have that primary house is the major asset. Sometimes they don't even have significant retirement, so they have to get some cash out of the house. And most of the time they're just like, okay, well then I guess we got to sell it, and then nobody has a place to live, or, you can't keep the kids in a certain school district and things like that.
Mm-hmm. Mm-hmm.
Interesting. Okay.
So
So,
the person
yeah.
who's getting the payout, just as a thought, made me think about it, and I apologize for interrupting, but that person who's getting us a payout, if they are 62, they can use the reverse to purchase a home for themselves. So
Mm,
remember, we've split the homes. We've split the ownership, party A and party B. Well, party A gets the house that was the family home. Party B's got to go out and find a place to live. Party B, if they're 62 years old, doesn't have to put a loan on that home if they don't want to. Maybe they don't want a mortgage payment of $3,000 a month.
right.
They could use the reverse mortgage to purchase a home. Again, it's about, if you're looking at a $200,000 house, you're probably still coming to the table with 40%. But if you've got that lump sum, why not consider how you might want to use that for your own lifestyle?
Oh, and absolutely. A lot of times people, again, one person may want to stay in that house, but the other person may want to downsize into a condo, and it
Right.
does allow that transition. So I think that is great. I think one of the remaining questions that we have, and I covered at least one of them at the beginning, but what are some other common myths that we get wrong, or professionals out there, because a lot of people that watch the mediator podcast are
Mhm.
professional CPAs or lawyers or financial professionals that are in this mediation space, and they
Mhm.
need to know enough about these financial options to explain it or give it as an option to their clients. So, like, what
Right.
else are we getting wrong, or the main questions that you get asked every day that you're like, that is not how this works, you know?
Absolutely. So I pulled up this little sheet because I did have something that a lot of professionals overlook, and I wanted to make sure to address it. Well, we've already talked about you could buy a new home, so the other party could always buy something to live in. It's not like they are now destitute and on the street or renting, forever renting. They have that opportunity to buy. The income from the proceeds of a reverse mortgage is not taxed. But please, again, I'm not a tax advisor. Let's make sure that you check in with your own tax advisors on that. But the last two big things are the line of credit, which grows over time. So in either party, you could overfund a purchase and put more money into the new house you're having so that it now has a line of credit and grows. It's your emergency fund for the house. And if you don't use it, it's going to grow at approximately the same interest rate as what the interest is on the loan. And the last one is that the reverse mortgage is a non-recourse loan. And a lot of people don't know what that means or don't remember what it means. And a non-recourse loan means that there is no recourse to you or your heirs if the balance is higher than the value of the home. And that's huge. Nobody's going to come after your heirs or yourself because the balance is too high. If it goes upside down, the words that we use, it scares everyone, and you're still living in it, as long as you pay your property and taxes, no one is going to come make you leave that home. That's the non-recourse feature.
And I mean, realistically, off the balance, if you have that as a line of credit, you could be using the line of credit to pay the taxes or the insurance or whatever
Oh,
each year.
constantly. Yes, I have many people who do that. I mean, we retire because I'm kind of in that retirement age, but I love doing this job, so I'll be doing it forever. Um, all of a sudden you don't have as much money as you thought you were going to get. And then there's medical issues. I mean, there's just 1,000 things out there besides inflation and eggs costing too much. And that, all of a sudden you just don't have enough money coming in. Or you're not saving. And the reverse mortgage is a classic way that I see people paying their taxes every year. And they don't panic about it. They get the notice, and I can't tell you how many people call me. In Colorado, you get this notice with the bright letters across this. It's the tax bill. And I get a call every season. And I say, remember, you have the reverse mortgage. Let's check and see what the balance is. Here you can pay it. You pay in full, or you can pay it in half. But either way, you have to pay it. And that's a great resource for seniors that are worried about how to stay in their homes. You bet.
Well, and I think you've covered about 5 different ways that you can utilize a
Yeah.
reverse mortgage. So, like, let's say that people are interested, they've listened to this process. What are the first steps to somebody going through this process, or how do they reach out to you? Maybe you can tell us a little bit about your company, but how would somebody get started in this? Because you operate out of 4 or 5 different states, and
Right.
so you can cover in those states. But what would somebody do then to step forward with this process?
Well, even though I don't cover all of the states, I have a great resource, a referral resource for the other ones. And I have used them successfully with girlfriends' mothers. So, I got to hear it wasn't just a random stranger. I mean, mom was right there letting me know how it was going through the whole process. And it went beautifully. And the daughter said she couldn't have made it any easier for her. And the daughter lived here. Mom lived in Texas. So it was not like they were just down the street. So if you don't live in the 4 states that I work in, then don't think that you can't give me a call and I will find a resource for you. That's probably, I say if you go out on your own, when you would see a doctor, but you check for, references. Let's do our due diligence and make sure that the person doing the reverse mortgage really does them as a career. There are a lot of people that will say they offer it, but they may not do the 1 or 2 a year. And that doesn't mean that they're the worst, but it also may not mean that they're fully going to understand a specific niche that might work for you. And so I would say ask questions. Make sure that you're working with a mortgage professional to start out with, and ask them how many reverse mortgages they've done, and go from there. Never give your social security number out. Don't do that. Please don't do that. Play it like your ace in poker. Hold it to your chest. We don't need it until the last minute, so hang on to that. And call me. It's probably the best way to just get started, is to see what's out there.
Well, and that is one of the final steps, is you can tell us a little bit more about Laura Phillips. And, we said that you're in Colorado, but tell us a little bit more about you, the company that you work for, and then we'll scroll some of the information about how they can reach you, because you would be a great resource to get started. And this is not a traditional mortgage.
Right.
And so you really need to reach out to a specialist if this is how you're going to utilize it. But I'm like thinking real estate investors are sleeping on this a little bit. But again, you would have to be 62, but still, like that's not a low hurt. Like a lot of people are still heavily investing after that age. So how do they reach out to you, Laura?
Well, you can get my telephone number, which is 303-817-4611. If I don't pick up, please leave a voicemail. I do return all of my voicemails. So please do that. You can reach me by email, which is laura@lauraphillips.com. Again, 2 L's in Phillips, remember that. And I reach out and I'll respond to all emails. And if I can't help you, I will tell you what I can do to find the right resources for you. I do have a website, lauraphillips.com. I am a broker, so I represent 5 reverse mortgage companies. So I call them the big 5. Everybody's out there. We've all heard of them. They have TV commercials. You can't miss them. I represent them. I'm not a call center. You're going to talk to me as a real live body in person. I like to be a boutique lender, so I like to work with you personally and get to know you, get to know your needs, and go forward. You're not going to see a churning situation or sound like I'm in a call center at all. You might hear the dogs bark, but that'll be it.
And realistically, even if you're a professional that's in this space, kind of working with couples or a mediator, I think more often than not, we're all consultants and we're all looking for referral sources that we can trust and rely upon. And I think with your experience that you're really a trusted resource, and they can reach out to you. If you are not the right person, you can probably direct them to where they need to go. And I really appreciate your information today. Is there anything else that we could add, or any closing tips that you have? Because we've covered a lot today.
Closing tips. I'd say look at it. It can't hurt. It can't hurt. Just add it to your mix of options. It doesn't mean you have to use it. I have people that look at it every year and put it like, okay, it's still in the future. But do consider it. I think you'll be pleasantly surprised that a reverse mortgage can do more for you than you thought. And it's not such a bad animal.
Well, and I think I'm going to talk to some of my financial planning, friends and
Mhm.
see if they're using it as some of their retirement options because it really, like I don't hear them talking about it. So I think that this would be a good suggestion. So we
Right.
appreciate all of the information. And if there anything changes in the space, we'll have you back to talk a little bit more. So
I
thank you,
appreciate
Laura.
it. Thank you so much, Melissa. It was a real pleasure to be on your show.
Awesome. We'll talk to you soon.